Hello and welcome. In this video, we will try to understand what a dividend is. Alright? Now, why do you keep your money in a bank? You keep your money in a bank to earn some interest on it. Correct? So instead of having cash lying around and doing nothing, you can save it in a bank and earn some profit or interest on it. Right? Now, why are you learning about the stock market? You are learning about the stock market so that you can invest your money in it and try to make a profit or increase your wealth. Right? Now, dividends are payments a company makes to share its profits with its shareholders. Okay? Just like a bank pays interest on the money you keep with them, dividends are the payments a company gives you if you own its shares. It is a way of sharing the profit. Alright? Now, when we say profit, we need to know what profit is. So let us learn that first. Okay? Now, I will take the example of an oil mill. Let us say that two friends have opened an oil mill and are operating it. Okay. Now, profit is equal to revenue minus expenditure minus tax to the government minus interest to banks minus depreciation and amortization. All right. Now, considering the oil mill, what is expenditure? Expenditure is the amount that the friends spend to produce the coconut oil. But it is not only just producing, it is producing and then selling it to the customers. So from the beginning till the end, procuring coconuts, drying them, making oil from them, packaging it, shipping it, all the costs involved in this come under the head of expenditure. Okay? So how much do the friends spend to make and sell their product is the expenditure. Alright. Revenue is how much the friends get when someone buys their product. Not just a single person, but how much money are they getting every month or every year by selling their product. Alright. So how much do they get is revenue. How much do they spend is expenditure. Alright. If the expenditure is more than the revenue, then the friends or the company will be at a loss. If revenue is more than expenditure, then the company will be in a positive state. I cannot say profit yet because there are a few other things. Alright. So after revenue and expenditure, we have taxes to the government. The company of the friends need to pay tax to the government from the revenue. Okay, from the revenue that they get. Next, they may have taken a loan from the banks. Correct? And an interest will be levied on it. So they need to pay the interest to the banks, and that is also paid from the revenue. Next, we have depreciation and amortization. Do not worry much about this. If the company has any machinery, all those costs are divided and categorized under depreciation and amortization. Okay, just remember this. This also has to be paid from revenue. Okay, so after deducting all these from the revenue, what the friends get is profit. Alright. For example, let us say that the company of the friends, okay, their revenue is 5,000 rupees. I have taken small numbers to keep the math simple. Okay. So let us say that their revenue is 5,000 rupees. This is the amount that the friends or the company has gotten in 1 year from people buying their products. Okay. Minus expenditure of 1,500 rupees. It has cost the friends 1,500 rupees to produce oil in that particular year. Okay. And then the company has paid 500 rupees in tax to the government, 500 rupees in interest to the bank, and the depreciation and amortization is 500 rupees. So when you do the math, you get 2,000 rupees as profit for that year. Okay. Now, what does the company do with this 2,000 rupees? This 2,000 rupees belongs entirely to the stockholders or owners of the company. Who are the owners of the company? The owners are the ones who hold the shares of the company. Okay. So in this case, the promoters along with the public who own the shares of this particular company are the owners. So the 2,000 rupees profit entirely belongs to these. Okay. Now, what can the company do with the 2,000 rupees? Well, the company has three options. First is to distribute the entire 2,000 rupees to the shareholders. The company can divide the 2,000 rupees equally among the shareholders and distribute it to them. If the company does so, the money that it gives to the shareholders will be called as a dividend. Okay. So a dividend is the profit that is shared with or given to the shareholders of that particular company. This is the first choice that the company has. The second choice is that the company can reinvest the 2,000 rupees back into the business. instead of giving a dividend, they can reinvest it back into the business, hoping to grow it. Okay. The third option is to do both, meaning some part of the profit can be given as a dividend and the rest can be invested back into the company. All right. Now let us see if giving out a dividend is better or if reinvesting is better using an example. All right. Here are the two main cases, case 1 and case 2. Case 1 is to distribute rupees 2000 as dividend. Case 2 is to reinvest 2000 rupees in the company. Okay. In the first year, for case 1, the investment is 8,000 rupees. How is this 8,000 rupees? It is 4,000 rupees from promoter A, 2,000 rupees from promoter B, and 2,000 rupees from the public. So totally it is 8,000 rupees. Okay, you can go back and verify. So the investment in the company is 8,000 rupees. And let us say that in the first year, 2,000 rupees is the profit that the company makes. Let us assume that 25% of the investment is obtained as profit. Okay. If the company gives out entire 2,000 rupees profit as a dividend, then the retained earnings are 0. What are retained earnings? Retained earnings are the profits that the company keeps for itself. What does the company do with retained earnings? It can do a couple of things which we will see later. Okay. And one of them is to reinvest the money back into the company. So in this case, retained earnings are 0. The total money of the shareholders is 8,000 because nothing has been reinvested back in the company. The profit is given as a dividend, that's all. Okay. Now when I say total money of the shareholders, this is the money in the company. Okay. Of course, shareholders get this 2,000 rupees as a dividend. And let us say that the shareholders use this for some other expenses. Okay, let us not consider this. The total money of the shareholders in the company is 8,000 rupees. Okay. Now let us see what happens in the first year for case 2. The investment is 8,000 rupees and the profit is 2,000 rupees. Okay. Here nothing is given as a dividend. Okay, so dividend is 0. Remember that a company does not have to compulsorily pay a dividend. It is the choice of the company. Okay, let us say that the company reinvests the entire 2,000 rupees back into the company. So the retained earnings are 2,000 rupees. Okay. Dividend is 0. Retained earnings are 2,000 rupees. Alright. How much money is with the shareholders? It is 10,000 rupees. How? 8,000 rupees was invested and 2,000 rupees was reinvested. and whatever money is in the company belongs to the shareholders. Correct? So 8,000 rupees plus 2,000 rupees equal to 10,000 rupees. Alright. So this is the total money of the shareholders. Now let us go to the second year. In case 1, the investment is still 8,000 rupees. The profit is 2,000 rupees, which is given entirely as dividend. Nothing is reinvested. So the retained earnings are 0. So once again, at the end of the second year, the total money of the shareholders is 8,000 rupees. Okay. Now, of course, the share price may go up and the total money of the shareholders may increase, but then it may decrease also, or it may stay unchanged also. So I have considered that it has not changed in the second year. Okay, just to keep the math simple. Alright. Now, in case 2, 10,000 rupees is now the investment because last year's profit was reinvested to produce more goods. Correct? So at the end of second year or in the second year, 25% of this, which is 2,500 rupees, is the new profit. And once again, they do not give any dividend and everything is reinvested into the company. Okay. So what is the total money of the shareholders? It is 10,000 plus 2,500 rupees, which is 12,500 rupees. Okay. In the third year, in case 1, the investment is 8,000 rupees. Profit once again is 2,000 rupees. I have kept it unchanged at 25%. Okay. And this 2,000 is given as dividend. Nothing is reinvested. And so total money of the shareholders remains 8,000 rupees. Okay. In case 2, in third year, 12,500 rupees is the investment and 25% of this, which is 3,125 rupees, is the profit. Nothing is given out as dividend and everything is reinvested. So the total money of the shareholders is now 15625 rupees. So you can see that the total money of the shareholders has increased a lot in case 2 when compared with case 1. In case 2, the share price could have tripled or grown 4 or 5 times. And as I mentioned, in case 1 also, it might have increased, but it might have increased by only a small amount, or it may have stayed the same also. Okay. It may have decreased in value also. That is also there. Alright. So you can see that by paying a dividend, the company is not growing as much. Of course, as shareholders, we are happy when we get a dividend, but it will be very small. As retail investors, if we have 100 stocks of a company, maybe we will get 1,000 rupees as a dividend, which is very little compared to the potential growth in the value of our shares. Correct? And this is why many companies go for the third option. Some part of the profit will be given as a dividend and the rest will be reinvested in the company. Alright. So this is just a made up example. And I have kept the percentages same so that the math is simple. Okay. This is just to give you an idea of dividend. Alright. Now, let us proceed further and learn about retained earnings. Okay. So, what are the retained earnings? What are they used for? Retained earnings are the profit that the company keeps for itself to do something. To do what? To expand the company, perhaps, or to diversify into new sectors. This is what is meant by reinvesting in the company. Okay. Sometimes the company may issue bonus shares to the existing stockholders. We will learn about bonus shares in a different video. Okay. When a company doesn't have much of an expansion plan, then instead of reinvesting back into the same business, it might offer bonus shares. Or if the company doesn't want to expand or diversify, they may give a special dividend also. Special dividend is a one-time dividend. Okay. So when we say retained earnings, they do not have to be used to reinvest and grow the company. The company can do any of these things. Okay. Generally, it reinvests to grow, but then it can give out bonus shares or a special dividend also. Alright. Only when it is in a saturated market and doesn't have many options to grow, it issues bonus shares or gives special dividends. Alright. So I hope you have understood what a dividend is.